Certainly, here's a more detailed and engaging extension of your crypto caution message that emphasizes education, discipline, and strategy. Crypto has made headlines for creating overnight millionaires, but just as many people have lost everything. Why does this happen? Let's break down the most common mistakes. 1. FOMO, buying at the top. Fear of missing out. FOMO drives many investors to buy when prices are at their peak, like Bitcoin at $65,000, only to panic sell during the next crash, say at $30,000. Chasing hype, viral trends, or celebrity endorsements rarely leads to profits. Smart investing means resisting emotions, doing your research, and buying when prices are reasonable, not when everyone else is jumping in. 2. No exit strategy. Many jump into crypto without a clear plan for when to sell. Ask yourself these critical questions before investing. What profit level will trigger me to take gains? At what loss will I cut my losses to protect capital? Am I prepared to hold through volatility for years? Having predefined exit points protects you from impulsive decisions driven by fear or greed. 3. Scams and meme coins. The rise of meme coins like Dogecoin, Shiba Inu, and Squidcoin has attracted many hoping to get rich quick. Unfortunately, these tokens often experience pump and dump schemes where prices are artificially inflated and then crash hard, leaving late buyers with heavy losses. If a project promises huge returns with little explanation or utility, approach with extreme caution. Research the team, technology, and real-world use case before investing. 4. Lack of understanding of the technology. Crypto isn't just digital money. It's a complex ecosystem involving blockchain, decentralized finance, DeFi, smart contracts, staking, and more. Investing without understanding these concepts is like buying stock in a company without knowing what it does. Take time to learn the basics. Resources like beginner guides, podcasts, and videos can help you grasp what's behind the hype and identify projects with real potential. 5. Using leverage. Leverage allows you to trade with borrowed money, amplifying both gains and losses. While tempting, many inexperienced traders have lost everything by overleveraging during volatile market swings. If you're new, avoid leverage completely. Even experienced traders use it sparingly and with strict risk management. How to invest wisely in crypto. Focus on quality projects with real-world utility. Bitcoin, Ethereum, and Solana are examples with strong communities and active development. Think long-term. Crypto markets are volatile. Patient holders often see better results than quick traders. Never invest money you can't afford to lose. Treat crypto like a high-risk part of your portfolio, not your life savings. Diversify. Don't put all your funds into one coin or project. Spread your investments to reduce risk. Stay updated and keep learning. The crypto landscape evolves rapidly. Follow reliable sources and stay informed to avoid scams and spot opportunities. Final thoughts. Crypto is not a gambling game or a shortcut to instant wealth. It's a transformative technology revolutionizing finance, ownership, and data. To profit and protect yourself, education, discipline, and strategic planning are essential. The difference between those who win and those who lose is not luck, it's knowledge and patience. Start small, keep learning, and invest smartly. Your future self will thank you.